It's finally here. FHSA, known as the First Home Savings Account, is launching on April 1st this year. It combines the best of tax-free saving and RSP in Canada. Sounds like an April Fool's joke to me, but I guarantee it's not. While the banks are still working on it, I want to make sure you can understand what this account can do and how you can fully take advantage of it, whether you need to buy a first home or not. Yes, even if you are not interested in buying a place, you can still utilize it for your investment purpose, so make sure you stay until the end. In recent years, Canada has experienced a dual challenge of rising inflation and high interest rates, making it increasingly difficult for first-home buyers to enter the market. This is especially true in places like Toronto or Vancouver, where the average cost of purchasing a place is around $750,000. So by creating a dedicated account such as the FHSA, the government is encouraging individuals and families to save consistently and prioritize their goal of ownership. So in this video, we'll talk about what is FHSA, how is it different compared to tax-free saving or RSP, how is that different compared to the RSP first-time home buyers plan, what are the limitations of FHSA, and lastly, who is it for? The First Home Savings Account allows Canadians between the age of 18 and 71 to save up to $8,000 a year with a lifetime maximum of $40,000 to be put towards their first home. You can open a FHSA through a bank, credit union, or any other financial institution. You must be at least 18 years old, a Canadian resident, and of course have the intention of first-time home buyer. Now, this is really a key point because you consider a first-time home buyer if, in the last 4 years period, you did not occupy a home that you or your spouse didn't own. But even then, it's still a good idea to invest even if you're not the first home buyer, which I will explain it later. The most important thing to know about this FHSA is that it's tax-deductible account like RSP, tax-free when you withdraw your first home just like a tax-free saving, and you don't have to pay it back like an RSP first-time home buyer's plan. So let us first talk about the tax deduction part, meaning you are using your pre-tax income to save for the first home. To give you a very simple example, if you make $100,000 a year and are taxed at 20%, then you'll be taxed roughly at $20,000. Now, let's say you put $20,000 in your RSP. In the eyes of a CRA, you will only be making $80,000. You will drop down to 18% tax bracket, so you will only have to pay $14,000 in taxes. Right off the bat, you are saving $6,000 in taxes, and usually you get that chunk back in tax refund, and you can further put it back into your investment to compound it. This is basically how the RSP and the FHSA work, but the FHSA has an additional advantage that the RSP doesn't have. For RSP, everything is taxable upon withdrawal unless you are doing the first home buying or the lifelong education. But with the FHSA, on the other hand, you can withdraw that money without taxes as long as you use it towards your first home. This is very similar to a tax-free saving. The downside of the tax-free saving is, unfortunately, those are after-tax dollars, so you're not getting the tax benefit upfront. So you see, the FHSA combines both of the world. Now, how is the FHSA different from the home buyers plan that the RSP offers? Since 2019, the government bumped up the amount you can withdraw from the RSP up to $35,000 to put towards the purchase of your first home. But there are two problems with that. $35,000 nowadays unfortunately is not a lot of money for buying a place. And second, you must pay that money back over a 15-year period, so you're essentially taking a loan out of yourself. With the FHSA, there's no requirement to repay that money back. And if you have enough income, you can do both the FHSA and the RSP HPP plan, so you have $75,000 saved in total. Alright, let's talk about the limitation of the FHSA then. Things that you have to watch out for. First of all, FHSA can only hold for 15 years since you open or before you turn 71, whichever is the earliest. Otherwise, the tax benefit will be lost and the account will have to be closed. However, if the account holder decides not to buy a home within the time frame, they can either withdraw it, which results taxable outcome just like the RSP, or you can transfer the fund back to the RSP regardless of your RSP room. So it's like you have an extra $40,000 of RSP room that you can use now. Next, you have to be careful not to over-contribute as you'll be charged a 1% monthly taxes on the surplus amount. If you do have an excess FHSA amount, it is necessary to file a return to report the surplus and determine the payable tax amount. Another thing you need to know about the FHSA is that the room can only carry forward for 1 year. Unlike the RRSP or the tax-free saving, you can carry the room forward for life. For the FHSA, if you only make $5,000 deposit in year 1, you can only make $11,000 deposit in year 2. But if you still don't contribute, your limit in the 3rd year will be still $16,000, not $19,000. So it is very important to start early and keep track how much you put in each year. And unlike RRSP deadline, which you can contribute at the end of February of the following year, FHSA deadline is actually December 31st of the same year. And lastly, this is more a general rule of thumb of all investment, is that you should be cautious of what type of investment you choose to purchase within your FHSA. If you're looking to save money for down payment and ready to use it in the next 5 years, you have to be careful what types of asset classes that you hold. Investing your money in stock market might go up in value after a couple of years. However, there's an equal chance that your investment could drop by the same amount. If you're not careful, you could be in a situation where the stock market is going down and you're trying to buy a home and you may not have enough money for down payment. So planning and diversification are the keys to invest. Remember, the point being is not looking for the highest rate of return. The goal is look for a suitable rate of return so that you have money for your first home. So who is this for? Pretty much there are 3 groups of people who get benefit from the FHSA. The first group of people are the people who are looking into buying a place. Obviously, you can use this account to further boost the saving and combine it with RRSP and tax-free saving, you can save $100,000 in tax-free money. So on average, that's 25% more efficient. The second group will be you have the intention to buy a place, but end up you didn't do it. And that's okay, because you can roll back to your RRSP regardless of your RRSP room, and you can take it back out at a lower income year. And the last group, even if you already have your property, it's still a good idea to utilize the FHSA, especially if you're looking for retirement saving. Just like the reason above, you can write off your income like the RRSP and you can roll it back into the RRSP if you don't need it. But compared to RRSP and tax-free saving, the FHSA room can only carry forward for 1 year versus the others can carry for life. So the order matters here. You can use the FHSA to write off your working income now and bank the RRSP room and use it to offset future capital gain like selling investment property. So I personally think this is a fantastic account. I really don't see any downfall and we should take advantage early until they change the rules again. Say if you're in your 18 years old, regardless if you want to buy a place or not, you should still open one and contribute it, because even if you're not working at the age of 18, you don't have to use the tax deduction right away. You can bank it until you reach 25 or 26 when your income is higher, but now you have 10 years to let that investment to compound already. Alright, that's it from me. As always, thanks so much guys for watching. I hope you enjoyed it. This is Thomas and I will see you in the next video.